After a very tough start to the year, market conditions improved recently. Mid-February, the Federal Reserve suggested that external headwinds may justify a delay in interest rate hikes. As a result, equities globally rallied since mid-February. However, the global environment remains fragile. Economic conditions have weakened recently and have been below market expectations. Preliminary PMIs in Europe, in US, and in China have been below market expectations for both manufacturing and non-manufacturing activity. In this environment, hedge funds have outperformed traditional asset classes. In February, the Lyxor Hedge Fund Index is down 0.7% and minus 2% year to date, while traditional assets remain extremely challenged. Across hedge fund strategies, CTAs again outperformed in February, up 1.7%, suggesting that the trend remains your friend, while directional strategies such as long-short equity and event-driven have underperformed, while the others, fixed income arbitrage or global macro, are close to 0.5% in negative territory. Over the next few weeks, key central bank meetings will set the tone for global markets. The Federal Reserve will meet mid-March and is not expected to hike rates this time. And the ECB, in turn, is expected to announce additional easing steps. However, the credibility of central banks has been challenged lately, and the global economic environment remains unstable. As a result, the defensive positioning of hedge funds with a median equity beta below 10% at present is a support for a challenged market environment. In terms of hedge fund strategies, we still have a preference for those with limited market directionality, such as long-short equity variable bias or long-short equity market neutral. We also like CTAs and global macros, which are more defensive than strategies with more directionality, such as event-driven or long-short equity long bias, which are likely to remain under pressure as market conditions remain uncertain.